I used to think owning a rental house was one of the simplest businesses in America. I buy a house, someone else moves in, they pay me rent every month, the rent covers the mortgage, and whatever is left becomes my profit. At least that was the version I had in my head. My name is Ethan Miller, and a few years ago I decided to test that idea for myself in Columbus, Ohio. Rental property seemed almost perfect. I could use part of my savings as a down payment, borrow the rest, put a tenant in the house, and let the rent help pay for an asset I would eventually own. So I started looking for a single-family home in the suburbs. Eventually, I found one for $285,000. That was when the idea stopped feeling simple. Buying a $285,000 house did not mean I only needed to think about the purchase price. I needed a down payment, closing costs, insurance, property taxes, inspections, repairs, and enough cash left over for surprises. I financed most of the purchase with a mortgage. The moment I signed the papers, I owned an asset worth hundreds of thousands of dollars while also owing the bank hundreds of thousands of dollars. That difference mattered. The house had my name on it, but the bank still expected its payment every month. The mortgage did not disappear if a tenant moved out. It did not shrink because something broke. Before I could rent the house, I also had to prepare it. Some rooms needed fresh paint. A few fixtures had to be replaced. I changed the locks, checked the plumbing, tested the appliances, cleaned the property, and fixed small problems that had seemed almost invisible during the viewing. None of those expenses looked dangerous alone. $300 for one fix, $700 for another. Then a repair that could easily cost $1,500 or more. But the small numbers kept stacking. Everyone notices the giant number attached to the house. Almost nobody talks about the smaller numbers that start draining cash the moment the purchase closes. Then came insurance, then property taxes, then the cost of preparing the lease and finding tenants. By the time the house was ready, I had committed far more cash than the down payment alone had suggested. Eventually, I found a family willing to rent it for $2,350 per month. At $2,350 a month, the property could bring in $28,200 per year. But that was the first major illusion. The $28,200 was revenue. It was not profit. Every month, the rent arrived and immediately started disappearing into different buckets. The mortgage took the largest share, property taxes took another, insurance took another. I needed money for maintenance even when nothing was broken, because eventually something would be. I also needed reserves for vacancy, cleaning, tenant turnover, and repairs I could not predict. The amount left over was much smaller than the rent payment. That was when I understood that I was not really in the business of collecting rent. I was managing the gap between what the property earned and what the property consumed, and that gap could be surprisingly thin. Still, there was another side to the deal. Part of every mortgage payment reduced the loan balance. Month by month, the tenant was helping me increase my ownership in the property. That was equity. If the house also increased in value over time, I could potentially make money in three ways: monthly cash flow, mortgage paydown, and appreciation. Clearly, it was not a machine that printed $2,350 every month. It was a leveraged asset with income, debt, expenses, risk, and the possibility of long-term value. For the first few months, everything worked. The rent arrived on time. The mortgage was paid. The house stayed occupied. My spreadsheet looked stable enough that I started wondering whether I should eventually buy a second property. Then, in the middle of summer, the air conditioning system stopped working. That was when the spreadsheet met reality. The air conditioning repair was the first moment I understood how misleading rental income could be. Until then, I had been looking at the house through the clean logic of a spreadsheet. The family paid me $2,350 every month. The mortgage went out. Taxes and insurance were predictable. Whatever remained looked like cash flow. Then one repair arrived and reminded me that houses do not behave like spreadsheets. The technician gave me a bill of about $1,800, enough to wipe out several months of the money I had been calling profit. A few months later, the water heater started failing. Replacing it cost roughly another $1,300. Again, money went out. That was when I started asking a better question. How much money did the house actually keep? At $2,350 per month, my annual rent was $28,200 if the property stayed occupied for all 12 months. But that $28,200 was not mine to keep. There was the mortgage payment, which included both interest and principal. There were property taxes, there was homeowners insurance, there were maintenance costs, repairs, cleaning, and unpredictable expenses. I also learned that not every dollar leaving my account was economically the same. Mortgage interest was a financing cost. It was the price I paid for using the bank's money. But the principal portion of the mortgage payment was different. That money reduced my loan balance and increased my equity. So my cash flow could look weak while my ownership in the property was growing. Suppose I collected $2,350 in rent and, after the mortgage, taxes, insurance, and average maintenance, only a few $100s remained in a normal month. But if part of the mortgage payment had reduced my debt as well, my financial gain was larger than the cash sitting in my checking account. I was earning in two places. One was visible, cash flow. The other was buried inside the mortgage statement, equity. And there was potentially a third source of return, appreciation. If the house became more valuable over time, the increase belonged to me, even though I had originally purchased the property mostly with borrowed money. That was the attraction of leverage. I controlled a $285,000 asset without paying $285,000 in cash. If the house increased in value by 3%, that would be an increase of $8,550. But leverage worked in both directions. If the house fell in value, my mortgage balance did not fall with it. The bank still expected exactly what I owed. I could not treat appreciation like guaranteed income. I needed the property to survive, even if prices stopped rising. So I started looking for small ways to improve the economics without buying another house. The property had a garage, parking, and extra storage space. Depending on the lease, those features could support slightly higher rent. An extra $50 or $100 per month would not make me rich, but it could matter over a year. Rental property margins are often built from small advantages: a better purchase price, a lower mortgage rate, stronger rental demand, fewer repairs, a little extra income. Individually, none of those things looked dramatic. Together, they determined whether the property produced cash or constantly demanded new money from me. A house could also be profitable on paper and still create cash problems in real life. If I earned $3,000 over a year but suddenly needed a $5,000 repair, the long-term investment might still make sense, but my bank account would not care about the theory. I needed cash available when the house demanded it. So I stopped treating every leftover dollar as money I could spend and started building a reserve. That reserve felt boring compared with using every dollar to buy another property. But the longer I owned the house, the more I realized it was not wasted money. It was part of the business model. Because the next problem was not going to ask whether I felt ready. And eventually, the family paying me $2,350 every month decided to move out. When my first tenants told me they were moving out, I thought the problem was simple. I would clean the house, list it again, find another family, and continue collecting rent. What I underestimated was the cost of the gap. The moment the house became empty, the income stopped. The mortgage did not. Taxes, insurance, and basic maintenance continued too. For almost a month, I had no tenant sending me $2,350, but the house kept sending bills to me. That was the first time vacancy felt real. Before owning a rental, I treated occupancy like an on and off switch. In reality, every empty day had a price. 1 month without rent meant $2,350 of expected revenue disappeared immediately, and that was before I paid anything to prepare the house for the next tenant. I paid about $350 for a deep cleaning, roughly $1,100 for repainting and touch-ups, and another few $100s replacing small damaged items. None of those costs looked enormous alone, but together they mattered. Then I had to advertise, schedule viewings, review applications, and screen the next tenant. If I handled all of that myself, I saved money but spent time. If I hired help, I saved time but gave up more of the property's income. That trade-off became obvious when I looked into property management. A management company could collect rent, coordinate repairs, market the property, and handle turnover. That sounded attractive, but management was not free. A typical management fee could take around 8% to 10% of the monthly rent before I saw it. There could also be a leasing fee when a new tenant moved in, sometimes equal to a large portion of 1 month's rent. Suddenly, something that had looked passive from the outside started to look like a small operating business. I had customers, I had maintenance, I had contracts, I had unexpected expenses. I could not simply close when revenue slowed down. The debt stayed open, the bills still arrived. Then I started thinking about the air conditioner. A plumbing leak could damage several rooms. One major repair could consume the cash flow from an entire year. 2 bad events could force me to add my own money. That possibility changed the way I viewed profit. If the property generated a few $100s in positive cash flow during a good month, I could not automatically treat that money as spendable income. Part of it belonged to the future. It belonged to the next vacancy, the next repair, the next turnover, the next surprise. So I started keeping a larger reserve specifically for the house. That reserve became essential for me. It was not exciting. Cash sitting in reserve did not make my returns look impressive, but without it, one bad month could turn a manageable problem into debt. I also stopped assuming that 12 months in a year meant 12 months of rent. That assumption made every forecast look better than reality. If I expected some vacancy, maintenance, and turnover before they happened, the numbers became less attractive but more useful, and that was the point. I did not need the property to look good on paper. I needed it to survive in real life. The strangest part was that the house could still be a decent investment during an annoying year. The mortgage balance was slowly declining. The property could still gain value. A future tenant could eventually pay a higher rent, but those long-term benefits did not solve short-term cash problems. Equity could be growing while my bank account was shrinking. That was the second major lesson the house taught me. A rental property can be profitable and still put its owner under financial pressure. After the vacancy, repairs, cleaning, and new tenant costs, I finally had the house occupied again. But by then, I had stopped asking whether rental properties made money. I was asking a harder question. Why did some rental houses work so well, while others seemed to drain their owners year after year? After a few years of owning the house, I realized I had been asking the wrong question from the beginning. I wanted to know whether rental property was profitable. But 2 houses could look almost identical and produce completely different financial results. The difference started with the purchase price. If I paid too much, everything became harder. A larger mortgage meant a larger monthly payment. More of the rent disappeared before I could cover taxes, insurance, maintenance, and vacancy. A cheap house was not automatically better either. I could buy a property far outside Columbus for less money. But if fewer families wanted to live there, the lower price could be canceled out by weaker rent and longer vacancies. That was the first major reversal. The cheapest property could become the more expensive investment. Location affected almost every part of the equation. A house near good schools, employment centers, and transportation could be easier to rent. Those features did not guarantee success, but they influenced demand, rent, and how quickly I could replace a tenant. Then there were taxes. 2 houses with the same price and rent could produce different cash flow simply because one carried much higher property taxes. Insurance mattered too, so did the mortgage rate. A deal that worked with cheaper financing could become unattractive if borrowing costs increased. That meant I could not judge a property by rent alone. I needed to compare the entire system: purchase price, down payment, mortgage payment, taxes, insurance, expected repairs, vacancy, management, and realistic rent. Only after all of those numbers were included could I estimate whether the property actually had room to breathe. I also learned to stop using perfect assumptions. If my spreadsheet assumed 12 full months of rent, no repairs, no late payments, and 0 turnover costs, I was not analyzing an investment. I was describing a fantasy. So I started building bad months into the calculation before I bought anything. I assumed vacancy, repairs, and turnover would eventually cost money. I kept an emergency reserve instead of investing every available dollar. That made some deals look worse. Good. I wanted weak deals to look weak before I owned them. One house I considered seemed attractive because the purchase price was low. The rent looked reasonable compared with the mortgage, but the area had weaker rental demand and fewer nearby employers. If that house sat empty for 2 or 3 months, the cheap purchase price would not save me. Another property cost more, but sat closer to schools, jobs, and transportation. That changed how I thought about risk. A rental does not need the highest possible rent to be valuable. Sometimes the better property is the one that produces slightly less on paper, but performs more consistently. Consistency matters because my mortgage is consistent. The bank does not accept strong demand as payment, it accepts cash. By then, I understood why experienced landlords cared so much about reserves. A reserve was not just protection against repairs, it bought time. It allowed me to survive a vacancy without panicking. It allowed me to fix a problem properly instead of choosing the cheapest temporary solution. It allowed me to wait for a qualified tenant rather than accepting the first application because I desperately needed next month's rent. That flexibility had financial value. Slowly, I stopped thinking like someone who owned a house and started thinking like someone operating a business. The goal was no longer to find the cheapest property. The goal was to buy the right property at a price where the rent, financing, location, taxes, and risk all work together. Once I understood that, buying another house stopped feeling like a bigger gamble. It started feeling like a calculation I could repeat over time. Once I understood what made the first house work, I stopped seeing it as a single investment. I started seeing it as a system. The mortgage balance was falling, rent could rise over time. The property itself could become more valuable. And every year I avoided a major mistake, my equity improved. Most of the wealth was still trapped inside the property. If the house was worth more than what I still owed the bank, the difference was mine on paper. That equity gave me options. I could keep the property, sell it later, or use some of the accumulated equity and saved cash to help purchase another rental. That was how the second house entered the picture. I did not buy it because the first property had made me rich. It hadn't. I bought it because the first property had taught me how to evaluate the next one. This time, I focused on rental demand, taxes, financing, maintenance, cash reserves, and realistic occupancy. When the second property became occupied, something changed. With 2 houses, the risk was spread across more than one tenant and property, but the expenses multiplied too. 2 houses meant 2 roofs, 2 heating systems, 2 sets of plumbing, 2 chances for vacancy, and 2 mortgage payments that had to be made whether rent arrived or not. Scaling did not remove risk, it multiplied income and responsibility. Over time, I added a third property. Now the business felt different. Cash flow from several homes could become meaningful as mortgages were paid down and rents increased. At the same time, equity was growing. That was what I had misunderstood. One rental rarely creates enormous wealth quickly. The real power comes from holding good properties while tenants help cover financing, and I keep enough cash to survive bad periods. But more leverage meant more exposure. If mortgage rates rose, new deals became harder. If property values fell, I could lose equity while the loan stayed the same. If several tenants left at once, my income could fall while every mortgage remained due, and 2 major repairs in 1 month could make a large reserve look very small. That was why I stopped calling rental property passive income. The income can become steady and the work easier with systems or a manager, but the financial risk never disappeared. The business required discipline. I needed to buy carefully, finance carefully, maintain reserves, keep the properties desirable, and never assume that rising prices would rescue a bad deal. In a strong scenario, rents increased, homes stayed occupied, repairs stayed manageable, and values rose. My cash flow improved while mortgage balances declined. In a weaker scenario, high mortgage rates, long vacancies, falling prices, and expensive repairs could turn the same portfolio into negative cash flow. The houses did not know which scenario I wanted. The numbers mattered. Looking back, the lesson was not that rental property was good or bad. It worked only when the purchase price, financing, rent, expenses, location, and reserves worked together. Revenue was not profit. Equity was not cash. Appreciation was not guaranteed. and a house that looked profitable in a perfect year could still lose money in a normal one. I started with one $285,000 house, thinking rent would make me money every month. What I actually built was slower and less glamorous. I built equity, cash flow, experience, and eventually a small portfolio. That was the business. Not buying houses and hoping prices went up, but buying assets carefully enough that ordinary decisions could survive long enough to compound. If this story helped you see rental property differently, subscribe. And I am curious, would you rather own one fully paid off rental or several properties with mortgages? Because in real estate, the biggest return rarely comes from the house that looks richest on paper. It comes from the deal that can survive reality. If this video helped you understand rental property a little better, hit the like button, subscribe to the channel, and check out the other videos here for more practical stories about money, business, and investing.